Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Steve, thanks for joining me back on the show, mate.
Great to be on.
For those who perhaps haven't seen the first instalment where I talked to you and about the Forager story and your story, I'd highly encourage everyone to go back and listen to that before hearing Steve's thoughts on the markets today. But I thought it'd just be a good opportunity to get you in. I've been reading some of your stuff lately. There's been a few portfolio additions which I thought were maybe some people thought they were pretty hairy, but I thought they were, I think the thesis there is pretty clear and I can see why you like it. So I'm keen to talk about one of those today. But also you've been doing a few videos for your blog and for your YouTube channel, which I've been tuning into each week and they've been really engaging. So I thought maybe we could talk to some of those and just get your thoughts on the market. And I think a great place to start was not to timestamp this conversation too much, but we saw this week that Australia is heading for a recession. I don't think that's a surprise for many people, but we're seeing a lot of stimulus in the US. We're seeing riots in the US. We're seeing stimulus in Europe. All of this, I guess, during COVID and post-COVID recovery, we're talking, some big macro ideas here. People are just trying to think, what has the market gone too far? How do we make sense of this? So I'm just going to throw it over to you. Maybe we can just go back and forth. Maybe you can take it in two lenses, the local market and then internationally as well.
Yep. So a couple of things from my perspective. I actually don't have a strong view at the moment. I sort of sit there and I look at it and I say, well, I didn't think our Aussie market in particular was stupidly overpriced back in February. I think the magnitude of what's happened here has probably been less than would have been feared for sure at the bottom. And, we've still got a market that is down 14 or 15% from that level. So I think that's probably roughly fair and okay. From my perspective, it's still quite exciting because within that overall market level, you've had a lot of very, very differential performance. So some stocks are back trading at their all-time highs. Other stocks haven't yet recovered. And, some of those that they haven't yet recovered and in our portfolio in particular are coming out and saying, we're actually doing okay here. And there's a huge amount of government support. And I think people are probably underestimating the level of government support here for the Aussie market. So that's the big picture in terms of where I sit at the moment, is that it's probably roughly fair. I recorded that video last week and have been engaging in a bit of debate about it because I think framing the question is really, really important here. I think people are looking at where the market was 2 months ago and saying it's up a long way, therefore it must be overcooked, rather than where is it relative to where it was back in February and is that appropriate? Because I think if the market had fallen 20 and we'd recovered 5 to get to where we are today, a lot of people, even with the market at the exact same level that it is at, will be saying, well, that sounds pretty reasonable to me. It's the magnitude of the recovery that's got everyone, I think, surprised and concerned. And I actually think it was the magnitude of the fall that was massively overdone, and that has created the room for this recovery rather than today's absolute level of the market being stupidly optimistic. I still see plenty of businesses that, are going to earn in a more normal environment profits that could give you very high returns here relative to today's interest rates.
Do you think it's a combination of the velocity, like you kind of touch on the speed at which the markets fell and then come back? I think we've got the anchoring bias aside there, but there were headlines. It's the fastest crash, and then you see this giant recovery. Do you think that plays into more of the thinking than, I guess, like you said, the absolute level?
And I have never ever seen anything like it. I'll be very clear about that. I mean, the financial crisis for me was sort of a slow burning blow up after blow up. The market took a long time to wake up to the reality there. Some people arguing that this is the same, but the speed of what happened in March, I have never seen anything like it. I've never seen markets as dysfunctional as that either. Just the lack of liquidity, the lack of a clearing mechanism for a lot of, in some cases, fairly large companies. You know, we had businesses in our portfolio that were down 20 and 30% in a day on a couple of $1,000s worth of shares traded. And people are looking at that saying the value of my company is down 30% here. And I just look at it and go, someone exchanged $1,000 worth of shares with someone else for a stupid price. Does that really impact the value of what things are? So I think that speed is really, really important. And it has contributed, I think, to the surprise around the recovery. I also think the psychology is really important about what I think people misunderstand what the stock market actually is. They just equate, okay, we're going to have a recession, therefore the stock market is going to go down. But investors in the stock market were thinking about that back in March. So the question is not, are we going to have a recession? It's, are we going to have a recession that is going to be worse than what people thought yesterday? And if the answer to that question is no, then people are probably sitting there saying, well, I thought yesterday it was going to be really, really bad. Today, I think it's going to be a little bit better. Therefore, I will pay a slightly higher price for the future. And really trying to frame that question, I think particularly for a lot of retail investors, is important that the stock market is not the economy, it's the expectations of the future rather than what we're looking at today.
I think that's the thing, right? You see, and I know you're quite prevalent on Twitter, and I sometimes read some musings on there. We see that quite a bit, right? People are really, they're anchoring their expectations, you know, to what might be the facts from last quarter. For example, they see recession and they think, how can the stock market be going up? But people have to remember here that it's forward looking. And I think you bring this back quite often to, you know, multiples of profit and multiples of cash flow and that type of thing. So when you're looking at these companies, I guess you know, that's probably where you're seeing, that's how you're gauging value, gauging expectations rather than just say absolute levels or prices.
No, absolutely. And it's a pretty simple exercise for us. The first gate is the business going to survive the environment that we're going to go through? So you need to get confident about that. We've been doing a lot more, even the past few weeks, I think, in the more cyclical end of the market, the stuff that is going to suffer here, but is going to recover later. And we've been switching out of some of the things that have, not completely out, but rebalancing out of some things that have done very well for us into some of that later cycle stuff. And you run the risk there that we have a resurgence or the economic downturn is worse. So we're still in that space focusing on businesses. They're going to suffer, but they're going to survive. So have you got the balance sheet? Have you got the operational resilience here to get through this? And then next really important step is, can I find a business that is going to suffer, but is going to come out of this in a stronger competitive position? And I think that's one of the most exciting opportunities at the moment is some of these businesses that are going to lose money this year. Like it'll be loss making, but their competitors are going to lose a lot more and their competitors are going to be strategically challenged for a long time to come. And in 2 or 3 years' time, you're looking at these businesses going, the profit margins are higher than ever before. The market share is higher than ever before. And I've made many, many multiples of my money. So we're absolutely focused on that first gateway. Is it going to survive? And then what does it look like in a normal environment? How long do we think it's going to take to get there? And then what sort of return am I going to be earning on today's purchase price in that environment? And trying to find the most attractive of those that are out there. So it's really, I find it a lot simpler to think about that. And I think if you had that conversation with most people, you probably wouldn't have had too many arguments. At the point where the market was down 40, most people would have said to you, you're probably going to earn 20% per annum on some of these businesses in 2 or 3 years' time. And I feel pretty confident about that. I'm just not confident investing in this environment because I'm worried that prices are going to fall further.
Yeah, that's funny you say that because I think we all overestimate ourselves, but even I was thinking to myself, you know, I don't like to think big picture, but about the economy and top down. But I was looking at some of these businesses and I'm thinking to myself, oh yeah, but there's so many unknowns and blah, blah, blah. But then some people coming up to me and saying, you know, what is the chance that this business is going to be around in a year? Okay, you're over that hurdle. Then what's the, you know, the likely outcome for that industry, for the business? I think that's such a simple framework to apply, but it's so effective as well. You mentioned there that you've kind of shifted towards, I guess, the latest cycle recovery, those kinds of companies. Do you have any examples of them? We're about to get to one that's kind of like that medium to longer term view for you, but anything in that kind of that mid-range bucket?
Yeah, for sure. I'll give you two maybe in our two different funds. So Wizz Air in our international fund is a low-cost airline in Europe. People might be familiar with or more familiar with Ryanair and EasyJet. Yeah. This is an Eastern European competitor to those guys, although they don't actually overlap on a huge amount of routes, but similar economics, really high return on equity historically, ability to deploy more and more capital into markets as they increase market share. And in this business's case, you've just got a fairly low penetration of flying in a lot of Eastern European countries that are growing quite quickly, and that penetration is growing quite quickly. So it's been a wonderful, wonderful business. And Ryanair and EasyJet have as well. I think people see airlines and think, I never want to invest in an airline because Warren Buffett wouldn't. In that low cost space, there have been some really wonderful businesses there over a long period of time. Now, to that question I was saying before, is it going to survive? This business has got 20 months worth of liquidity, assuming not one person catches one of their planes. Their results are out last night. They're saying they're going to be 60% capacity in the third quarter of the year, and then 80% capacity in the fourth quarter of the year. And a lot of those Eastern European countries are starting to recover quite quickly. So I think that's one good example of a business that I think can be really strong, and we might want to own for a decade here as this rollout and this reinvestment of capital happens. But the earnings are going to be cyclical, and I would guess it's going to lose money over the course of the next 12 months, but come out of it much stronger. One in the Aussie fund, I mean, we've owned it since the bottoms of the market here and been buying pretty aggressively, and the last few days have changed the equation a little bit here, but Tourism Holdings, which is listed in New Zealand. We buy Kiwi companies in our Aussie fund as well. This is a camper van and RV business. Apollo Tourism and Leisure competitors listed on the Australian Stock Exchange. We think that Kiwi business is a bit better business in terms of market share, a stronger balance sheet as well. And I think that space is probably going to recover in the tourism space much quicker than overseas travel. You're going to see people, Aussies going to New Zealand and wanting to use camper vans. We're already seeing in the US interest in that space is up dramatically. In fact, it's higher now than it was pre-COVID as people are considering domestic holidays. And Tourism Holdings, THL's got a pretty big US business as well. So they're two examples of businesses that are going to have really tough years when you look at their financial results that are coming. But I think if you look out 2 or 3 years, you're paying a really, really attractive price for both of them at today's levels.
Yeah, they're two interesting businesses. Is Tourism Holdings a large company?
It's sort of, 300 million market cap at today's prices, and we probably think it's worth double that. So, it trades between 700,000 and $1 million Kiwi dollars a day. So it's in the illiquid bucket for us, where we want to be careful about how big those position sizes are. But it's something that does trade rather than a tiny micro cap.
Why don't we talk a bit more about overseas markets? We see in the news, particularly last month, I guess a lot of upheaval in places like the United States, and obviously just coming out of COVID in Europe. One company that you've identified is a business that I know that you've received a fair bit of feedback on, good and bad, and that's Uber Technologies. So many people will be familiar with it as a ride-sharing business. It's one of those ones that come to the market just before COVID, and people are thinking, is it one of those sexy tech stocks? It's not really a tech stock. And I imagine some of the feedback you got being a quote-unquote value investor was a bit hairy. So maybe I can get you to talk to the big picture stuff, and then maybe we can step through some of those, I guess, misconceptions about the company and the strategy that you've employed there to really find that value.
Yep. I've always been interested in the business because the perception that it is going to be a loss-making business forever, it just doesn't sit right with me. This is basically an app, and they've got huge market share in a lot of Western countries for ride sharing. And I've always said, if you really cut back on the marketing here, you've got a pretty loyal customer base that's going to keep using your product. And how much does it actually cost you to run the data centers and develop the app and keep working on that stuff? So if you wanted to just stop today and say, we just want to milk the user base that we've got, you could have a very, very highly profitable business there. Now, historically, and the reason that we didn't invest it around the float was you didn't have any confidence that it was going to be run in that way, either now or at any point in time in the future. There was a guy who founded the business and was running it, and was probably the right person to get it to where it got to in terms of its market shares, but was just focused on growth at all costs. So a couple of triggers for us. First, change of management team guard. It comes to IPO with a lot of promises about running this more efficiently and running it for cash. And I've just seen, it's been a model that has worked very well for us in our fund to buy some of these loss-making businesses where all the value investors are looking at it and saying, I'm never going to buy a loss-making company, when you can paint a really clear path for how it goes to profitability in the future. And all of these businesses are high customer acquisition costs, whether it's a Xero or an Uber or any of these businesses. You spend a lot of money acquiring a client and you expense that. So Xero signs up a client, costs them, say, $100 to acquire them and get that client on board, and they get the revenue monthly. So in the first year, you might have $100 of cost and only $10 of revenue, but then you're going to collect $30 and $40 of revenue every year at almost no cost for a very long period of time. So the more customers you sign up, the more expenses you're reporting, the more money you're losing, but you're creating all of this value. And I think that model has been proven time and time again, and people should be more aware of it than they are. But I think it's a bit the same with Uber, although it's not the same marginal economics. You've got a lot more costs here. So I've been interested. I've been following it. It floated. The share price got hammered as a lot of insiders started selling their stock. They reported a couple of really good results. New CEO starting to deliver on some of those promises about moving towards profitability quite quickly. And then COVID. So we'd missed the opportunity, right? The share price is $27 up to $45. COVID-19 hits, and at one point Uber was trading down at 15. So we worked really hard to get the internal sign-off process done quickly. It had jumped to 25, the next day, basically. That's how quickly things were moving then. But I think our average entry price is about 24. And I just think it's a really interesting example of a business that is widely misunderstood by people. Although if you go and read any of everyone has the same thesis as us in terms of the numbers that's actually writing the research on it, that we're moving towards profitability here in 2022 and 2023. But the setup for me was a stock that is widely pilloried out there. And I like looking for situations where I think there's a real consensus view, and you're never going to say it's completely wrong, but I think the probability of that consensus view being right is much lower than is attributed in the share price. So for us, it's probably not a business that we want to bet on it being hyper successful and massively profitable, but I think at $24 you're paying a pretty low price for the world's biggest ride sharing company.
Yeah, you touched on a few things there, and I only worked this out once I read your write-up on it, which I'll link to in the show notes. Some of the markets in which it operates, it has 65% market share of ride sharing, which is incredible. When you think about that, it's so dominant in some of these markets. And when we talk about competitive advantages, we talk about, economies of scale. Obviously, it's invested a lot in infrastructure. It's got that marketing war chest that it can throw at new cities or opportunities if it needs to. One of the pieces of feedback that you got was that the company really shouldn't even exist and it's being propped up by cheap VC capital. What's your response to that?
Yeah, well, I outlined this in some detail in the blog, but I think there's a very, very good reason why the business exists. The first one is that you're competing against the taxi industry that is effectively overcharging because it's heavily regulated. So governments around the world restrict the number of licenses. They control the pricing. On a Friday night, you can't get a cab because there aren't enough of them, but that makes the license plates for these taxis. In Sydney, you were paying $400,000 to buy the license to operate a taxi at the peak prior to the ride-sharing guys arrive. So I look at that and I think whether you agree with it or not, these guys that are coming in an unregulated market don't have to pay that $400,000, and there's a huge amount of economic value there that's to be split up between Uber customer getting a lower price and the driver getting at least the same as they were getting driving a taxi before. So I think there's a regulatory reason for the business to exist. The other thing I think is really important is the product works, and it works really well. So I'll get taxis from work home all the time because it's easier for me to walk outside the building. There are cabs everywhere and I just jump in a cab. I get Ubers from home when I want to go somewhere on a weekend all the time because it's much easier for me to order it to my house, and the product just works. And people underestimate how hard usability is to get right. I mean, you run a digital business, so you've thought a lot about it and you realize how difficult it is. But as a consumer, the things that work best, you don't notice. As soon as something doesn't work, as soon as it's slow, as soon as it doesn't load, as soon as the car doesn't turn up, you get angry, you don't notice it. But as long as Uber's working smoothly, you're just sitting there thinking, oh, I'm just using Uber and this would be really easy to build this app. But that usability piece of it, I think, is absolutely fundamental and crucial. And I think they've done an outstanding job of it. And now they've got so much money and revenue that they can keep plowing into it, that I think it just keeps getting better and better from a usability perspective.
Yeah, it's one of those things where it's now reinforcing the moat, right? And we've seen news out in the last month or so that there's potentially a takeover on the table here for Grubhub, which, from what I can tell, will only serve to reinforce that market share, particularly in the US and a little bit further abroad. How are you seeing that play out? And do you see the deal, going ahead and all these types of things?
It's been part of our thesis that, so again, a little bit of the layout here. Most people think the rides part of Uber is loss making, and it's not. It's actually already profitable, and it's getting more profitable very quickly. So that's a very common misconception. And I had a lot of feedback from people where I just wrote back to them and said, have you actually read the latest annual report, and where is your view of this coming from? And it's, 2 years ago, I looked at the IPO, or it's an old perception of the business. So I think that shows you that the path is towards profitability in that side of the business. I think you need consolidation on the food delivery side of things, and I think it is going to happen. The hurdle with Grubhub is going to be regulatory, and I think the sentiment, particularly in the US at the moment, is very anti any sort of consolidation. So to the extent that regulators can stop that from happening, they probably will. But I think long term, the market will actually benefit from two rational players here that have got big networks and can spread the costs over a much larger number of people. Even the network effects in food delivery of being able to deliver 3 or 4 meals with one driver, because you've got the density that you need to do that. The economics of that are dramatically better, and therefore you can do it for a lower price than having 4 people that are all, you've got 4 different people walking into the same restaurant and then delivering the food to different places. So I think you're going to see rationalization there, either through people just pulling out or through the sort of consolidation that they're talking about with Grubhub and Uber. I think it'd be very good for the investment case if it happens, and experts in the space are saying it is a decent chance of happening. I just think the political environment makes it difficult at the moment. So I wouldn't bet my life on that happening soon, but I think in 5 years' time, you're going to have a bunch of geographical markets that look very similar to ride sharing.
Yeah, it's interesting because obviously the Eats business, for people who live in or around the CBDs of Australia, they would be familiar with the business and how convenient it is. But they probably see all different types of scooters going past outside. And we've had some here in Australia file for bankruptcy or, pretty much just go out of business completely. And you can only imagine that there's going to be some consolidation. And I think with the share prices and the returns some of these companies are generating, you spoke about it in the blog, but this fragmented industry does need to consolidate. It's just a matter of when and how it happens. If this deal doesn't go ahead, then maybe, Uber's still okay, and it's still going to, continue eating into that market share of the competitors. One thing you mentioned before was your entry price around $23, $24, the valuation of the business at that time, but it also has quite a few minority holdings, right? Like in other listed businesses.
Yep. So again, another one of the, I think, criticisms of the business was they're hell bent on global expansion and they're going to keep losing money in places like China and India forever. And I mean, the biggest change and the biggest confirmation for me that the new CEO is going to deliver has been exiting those markets, but they didn't just walk away. They mostly exchanged their businesses there for a share of the largest ride sharing businesses in China, Singapore. They own a bunch of these things around the world. It's hard to put a clear, it's similar to Uber in you've got to forecast when the business is going to turn to profitability, but they're on the balance sheet at $10 billion, and even the stake in the Chinese business alone, I can see being worth a decent chunk of that $10 billion. So I don't, is it worth 20 or is it worth 5? I don't have a really strong view, and I don't think that dictated the investment case. Certainly when it was $24, it becomes more important at today's price of 36. But those stakes are very, very valuable. And I think if you look at how much cash they burned there and what they've got back in terms of the stakes of the business, it actually wasn't economic suicide either. It was establish a beachhead, use it for your strategic advantage, and get something in exchange for it. And yeah, there's probably some markets where the net has been negative, but even going back and looking at the way they expanded and the things that everyone was critical of them for, you need to put that in the context of they've ended up with a big stake in some pretty valuable businesses as well.
Yeah, I think you said in your write-up, something like 100 cities for the Uber Eats business are already profitable. And like you said, the rides business is already profitable, and they've got these minority stakes. So if you're kind of thinking about this, some of the parts kind of valuation, it doesn't, particularly from the price that you got in, it doesn't take a lot to get to something that is very realistic. And if you can look past those headline figures, which people seem to be jumping to, it falls well and truly into that bucket of, there's a lot of value there.
You've got a big corporate overhead here. You've got a lot of share-based compensation. I think all of those things are important to factor into that. So, they report rides as a standalone segment, but I sit there and I say, well, I need to allocate a fairly decent chunk of all this overhead that they're spending elsewhere into that part of the business. But I still think that is absolutely right. You didn't need to be, there's some really, really conservative assumptions at $24 that still got you to a profitable outcome from there. It is harder for me at 36. It's not the same. You need a few more things to go right. I think they will go right. I still think the balance of probabilities are in your favor, but it's not the same equation that it was at substantially lower prices.
One thing you mentioned to me just in passing on Twitter was that, these types of environments where, see these dislocations, this uncertainty, it's your time to shine as a investor and as a business. I'm interested to know how you reacted when it all happened, because, if I'm looking for a fund manager, I want them to have these ideas on the table ready to go. Like you said, you reacted pretty quickly to Uber. How did you feel about, were you more excited by some of the prices you were seeing in the market over the past couple of months? And are you as excited to see those play out now?
Yeah, it's really interesting. And we've been doing a lot of introspection internally. It's probably since your podcast, it might have actually been the catalyst, but we've had a really, really horrible couple of years in our Australian fund. Like, the performance has been absolutely terrible in that fund. And we've done a lot of reflecting around what was in our control and outside our control. It's obviously been a horrible period for value investing in general, but we also got some things very wrong and stuffed some things up. And we spent a lot of time thinking about how we avoid doing that again, what we need to get right. And I think one of the mistakes that we've made historically is that we are contrarian. We like investing in things that other people are pessimistic about at a point in time. And we do that very, very well. We've just come out of this crisis and made enormous amounts of money for our clients by buying at the bottom. I think we can do that because we've got the psychological makeup. So Gareth Brown, who I've worked with for a very long time, and I are sitting there on the 23rd of March saying, this is it. This is as crazy a market as we've ever seen. And you buy when other people are fearful. And you touched earlier that a lot of people are sitting there at that point in time and going, oh yeah, but this might be really bad and it could be really horrible. And the thing to understand is you don't get those opportunities unless you're feeling like that. It's just not going to happen, right? You're not going to be sitting there saying, oh, everything's going to be fine, and I'm buying prices at 40%, some cases 70, 80, 90% on an individual stock basis, less than I was 2 months ago. So it's almost a prerequisite, and it is something that we get excited about. We were down to fumes in terms of our cash levels through that period, and we were juggling things around and trying to get it right in terms of the allocation, and we're very excited about it. I've been a bit surprised, I guess, about some of the other quite contrarian investors out of this that have come out of it very, very conservatively, even gone to significantly more cash through that period. But anyway, that's a bit of context. We do it well. I think we've made the mistake historically of trying to do it all the time. I need to be contrarian, and I want to go and find the stock that everyone hates and buy it. And I think that it's actually most of the time in financial markets, people are doing a pretty good job of pricing things fairly sensibly. And there's nothing wrong for us as a fund manager and as a fund about just being sensible. And we might have to be sensible for 7 or 8 years. We own a good collection of decent businesses and we think they're going to provide us adequate returns. And then we go through this market meltdown, and that's where we add all of our significant value by getting out there and buying the right businesses for clients at that point in time. And it's something I need to control as the CIO of the business. We've got a lot more depth in the team now. We've brought new people into the international fund to work alongside Gareth, and that bench that you talk about, being ready to invest. You know, our US exposure would have been 10 or 15% probably this time last year, and we'd now be 40 or 45, and we've been able to pick up some world-class US businesses because of some of the extra talent that we've brought into the business. But my job as CIO is to stand back and say, this is the time for us to be pulling the trigger and being aggressive and being really contrarian. And you know what? There are other times when the dial just needs to be turned to, this is a normal market. We need to be sensible. We want to own decent quality businesses that are going to give us a bit of ammunition, firepower to make the most of those opportunities when the meltdown comes. So, yeah, it's been great for us, and I've absolutely loved the past few months because we're back in an environment where we thrive. We just need to make sure that we do a better job in more difficult environments for us. You know, this is the environment that's actually easy for us. We need to make sure we do a better job in the environments when everyone's a bit more optimistic, and we just need to accept that that's a market where we're less likely to add extreme amounts of value.
Yeah, I think it's like you see this, you go through the years, you look at the big falls and the crashes, and you know that if you're a value investor who's done your work, that's the key phrase there, you've done your work. These are the days that you look for. And I think if I just, if I do a bit of a thumb suck, put my finger to the wind here, it seems to me that this good patch, if I could call it that, for value investors and for people that look for this deep value, I think the good times should continue. If I was to say, balance probabilities, it's probably like with the economic news we're seeing, with some of the uncertainty in global markets, this is a time that personally I'd want to be looking at these exposures. So I think I am really excited to see how it plays out for you, mate. I hope that the next time we have a call and the next time we have a chat like this, you can look back and you can say, you know what, that second time around was actually pretty good for us. It was a point in time where we looked up. So once again, Steve, as always, mate, I appreciate your insights. I appreciate you taking the time out to speak with us.
Been great on. Thanks a lot.